Risk-Ready English, Executive Collocations for Investor Reports. Welcome. Today we'll sharpen your risk communication so investors instantly trust your message. Why focus on language? Investors need clear, consistent risk terms to compare companies quickly and make decisions. Using the right collocations, set word pairings, like mitigate risk or risk appetite, makes you sound executive level and aligned with industry standards. Our goal is to be precise, calm, and actionable. Name the risk, size it, and explain what you'll do next. By the end, you'll have phrases that project control, not panic, and keep stakeholders confidently informed. Use powerful verb-noun pairs. Assess risk, quantify risk, mitigate risk. For example, we assessed supply risk, quantified the cost impact, and mitigated it via dual sourcing. Express relationship to risk with exposure to and sensitivity to. We have limited exposure to energy prices, but high sensitivity to freight rates. Planning tools matter. Scenario planning explores plausible futures. Stress testing models extreme but possible shocks. Define boundaries with risk appetite, what you're willing to take, and risk tolerance, maximum deviation acceptable. These collocations signal fluency and disciplined decision-making. Be direct. Disclose material risks and avoid vague words like concerns or headwinds without detail. Name the driver, metric, and threshold, a potential 8 to 10% input cost increase. Separate potential from realized impact. Potential margin compression versus realized Q2 delivery delays. Add timeframes to anchor expectations. Near term, 0 to 12 months. Medium term, 12 to 36 months. Long term, 36 plus months. Example, near-term risk of component shortages, medium-term risk to pricing power, long-term risk from regulatory change. Clear structure reduces ambiguity and helps investors price the risk accurately. Aim for transparency without drama. Balance openness with control verbs. Monitor, manage, mitigate, diversify, hedge. Avoid alarmist adjectives like severe or alarming, unless backed by data. Replace with neutral metrics. Inventory coverage of 14 weeks. Volatility at 1.3x baseline. Always pair risks with actions and contingencies. We face higher credit defaults. We're tightening underwriting and expanding reserves. If losses exceed 2%, we activate a cost containment plan. This tone shows you see the problem, own it, and have credible levers ready. Anchor claims with KPIs, ranges, and benchmarks. Churn improved to 6.2% versus a 7.5% sector median. Use proving verbs. Evidence indicates, data show, analysis suggests. They frame assertions as measured, not opinionated. Quantify uncertainty with calibrated terms. Likely, unlikely, possible, plus ranges. Revenue impact likely in the 5 to 10% range under the downside case. Include intervals or assumptions. At a 95% confidence level, or assuming demand normalizes by Q3, numbers lower perceived ambiguity and strengthen credibility. Try these concise lines. We are positioned to mitigate X through diversified sourcing and hedging. We maintain disciplined risk governance with quarterly stress tests and board-level oversight. Stress tests indicate adequate buffers under a 20% revenue decline and 300 bits per second rate shock. We monitor and recalibrate exposure as indicators evolve, reducing concentration when thresholds are breached. Mix and match. State the risk, the control, and the trigger for action. These phrases project readiness while leaving room to adapt to changing conditions. Start with the top material risks, the few that truly move valuation. Then group by category to aid scanning: market, credit, operational, regulatory, liquidity, technology, as relevant. For each item, repeat a clear structure: risk, impact, response, outlook. Example: currency volatility, risk. Potential 120 to 180 bits per second margin pressure, impact. Hedging and regional pricing, response. Stable under base case. Elevated under downside, outlook. This predictable format makes the section usable for analysts and keeps your narrative disciplined. Lead with strong collocations and support with data. Always state the risk, quantify it, then name the action. Calibrate tone: confident, not complacent; transparent, not alarmist. Quick practice: rewrite, "We're worried about costs," as input cost inflation, likely in the 5 to 8% range. "We're mitigating via supplier renegotiations and pass-through pricing." Another: replace "could be bad for cash," with near-term cash sensitivity to inventory build. We'll recalibrate exposure by slowing purchases and tightening terms. Keep iterating until every sentence is precise and useful.